If you're listening to this, there's a good chance you work within the real estate investing industry. There's another good chance that you would like to increase the sales of your products or services. Well, you're in the right place. United States Real Estate Investor is a platform you need to place your brand directly in front of your target audience. With our focused, growing audience of real estate investing beginners, enthusiasts, and seasoned professionals, you can continually reach our captivated viewers and listeners with ease. To learn more or to get started today, just visit UnitedStatesRealEstateInvestor.com/advertising. That's UnitedStatesRealEstateInvestor.com/advertising. Get ready to increase your brand awareness and your bottom line. Attract clients with content.
Universe Media Network.
All right, welcome to This Month in Real Estate Investing, where we help you navigate the news. I'm your host, James Brown. In this episode, we're going to be breaking down a variety of real estate investing news items, including foreign capital fuels U.S. housing, AI fears sink property stocks, and CMBS defaults accelerate. Don't forget, if you're watching on YouTube, you can share your thoughts and questions during the show. Let's start the show. All right, our guests today are Matt Meredith, David S. Rose, and don't let me butcher it, just jump in.
Reza.
Reza, how do you say your last name?
Motalapur.
Okay.
Don't worry about the last name.
Yep. All right. Awesome, guys. Let's start with Matt. Just let us know, your background in real estate and what kinds of investing you're doing, and we'll
definitely
jump in.
So my real estate background mostly has evolved around the legal sides, the protection of assets, the tax of it, the financial planning that revolves around it. Personally, I've done some projects. My wife and I got into it a little bit, fix and flips and things like that, but it's newer to me, and so I'm very cautious with it, jumping into it. But on the business side, I learned early that a lot of it, what people do and how they're doing it, and the correct structure of building it out to protect the people, protect the assets, and then how do you not pay all these taxes in it? And so that's mostly what my involvement with it has been. I'm still waiting to get into that multi-million-dollar deal, but I haven't reached it yet.
Nice. Cool. David.
So I was the other end of the spectrum. I was born into real estate. My family has been doing real estate for over a century. This literally is our 100th anniversary of the firm founded by my grandfather and great uncle. And with everything from an MBA in real estate finance to decades in building and developing, Donald Trump and I were actually honored at the same real estate development banquet back in 1989. So I helped pioneer the field of prop tech, real estate technology in the early 1980s, and have had multiple careers since then, including angel investing, early stage startup technology, and so on. And today I've brought it all back together, and I'm the chairman and CEO of USREM, the U.S. real estate market, which is the first major definitive platform. It's almost like a stock exchange, but not exactly, for investing in existing private real estate. So limited partners in real estate syndicates and funds can buy and sell their holdings with the full approval of the GP. So we've got about $3 billion in properties listed. We've been seed funded by many of the major real estate players across the country, and hopefully this will usher in a new era of real estate investing. And I'm working on my third book. I had 2 New York Times bestsellers on investing in technology startups. My third book coming out next year is the Real Estate Investing Bible, about all the different ways in which one can invest in real estate, to be published by Wiley.
Wow. All right. Great to have you here. Reza.
Yeah, James, like a lot of people who are watching this, I started as an individual investor. I was more involved in the global landscape. So I've invested in real estate in Cyprus, Dubai, Europe, Panama, several jurisdictions in Canada, have resided and done business in over 10 different countries and jurisdictions. So that's how I started. And now I basically help individual clients and families, go beyond that, get out of that box mindset and tap into the global real estate market. So that's my expertise.
Interesting. That's good. A lot of times we have just local expertise, so this is going to be good. And I think we have one news item on international investors investing here, so this is going to be cool. Well, let's jump in from CNBC. As American retail store anchors fade, private clubs are taking over more commercial real estate. Little short summary. So traditional retail anchors are struggling, as a lot of people know that are in commercial, and these private membership clubs are moving into these malls and shopping centers. So landlords like steady traffic and long leases, but this model depends heavily on affluent spenders, right? So what do you guys think about this model? And have you even heard of this kind of shift?
Yeah, I mean, I'm in New York, and so I actually belong to 7 clubs, believe it or not, which makes me a bit of a club junkie. So there are probably more, private social clubs in New York than any other city in the country, if not the world. And so, on the one hand, there is a serious trend about clubs, private clubs, social space. But in this, we're in the K economy where you have a lot of stuff happening at the upper end for the affluent and stuff that is not in any way touching the bottom of the universe. And this is very much an affluent upper end kind of component. And so while you are seeing a significant increase in private social clubs, I don't think this is a real estate story. This is not a major play. This is not replacing anchor department stores and shopping malls and so on and so forth. It's stuff that is very dependent on there being an affluent economy where people will, on a recurring basis, pay big bucks for these social clubs. And in any event, part of their whole thing is their exclusivity, which is small, which is the opposite of scale. So I think this is interesting. There definitely is an increase in uptick in social clubs as a societal thing, but I don't think this is anything anybody should be worried about in terms of real estate.
I'm curious. So why are you going to these, and why 7 different ones?
Because I'm a nut, but other than that, different clubs tend to have different purposes and different reasons why people come together, right? So I happen to be a book collector, and I belong to the Grolier Club, which is a book collecting club. 700 people, all of whom collect books. If you're not a book collector, it will be a pretty damn boring club for you to go to. But for those of us who are nuts about book collecting, it's amazing, right? Similarly, there are clubs for artists and clubs for conversationalists and business focused clubs and social focused clubs and so on and so forth. So university focused clubs. My university has one. So 7 is ridiculous, and nobody should do that. But if you happen to live in an environment where there are multiple options, there are maybe 1 or 2 or 3 or 4 that might actually fit a real need for you in terms of a third space or a social grouping.
Cool.
I've been seeing it here as well, James. Here in Texas, you're seeing what used to be the malls that were all going out of business, and then suddenly, a gym showed up, and then with the gym, you would have a coffee shop and the protein shake type place, and then the restaurant would come in, and so it's definitely repurposing what was originally there with, I think, a need, but again, you have to look at the areas that they're coming in. You had a failed mall. Was the mall failing due to, hey, nobody was interested in shopping at a mall, or was it due to economic circumstances in that area? I think the idea is fantastic. It's fantastic for the affluent, because now it's like what David's saying. It's a social aspect to it. You're getting out. You're being with other people of interest. There's a few around here that they're gyms, but they cater to pickleball, and you just have all these different aspects to it. But what happens when the bonuses stop for the affluent? Is this a short-term play that, hey, let's grab, initiation fees, monthly dues, things that we weren't getting, and they can be reoccurring? And then all of a sudden, what are we going to do if the market and the economy completely tanks? That, I think, is a long-term question. But they're popular now. They're coming up all over, and they're really kind of cool to hang out at.
Yeah. Well, everybody's craving connection, like real human connection. So I could see why it's becoming a thing. And pickleball also. Specifically that is going crazy. Yeah.
I refused to join the gym because I was like, where's the tennis courts? And they said, oh no, pickleball's bigger now. And I'm like, okay, thank you.
Yep. They're converting everything to pickleball, right?
Pretty much.
Yeah. Reza, do you have any?
No, I mean, I'm not a member of any specific clubs like David and Matt, but I'm more of a wanderer. So there, I get invited to different social events at these clubs, and I'm based in Toronto, so we don't have that massive boom that potentially in the major U.S. markets in Houston and New York. And also, I agree with Matt on terms of the sustainability in the long term. If these things are propping up, what is the underlying fundamentals now and going forward? But I haven't seen it on our side, and it's something that potentially could be. I don't think it's a major international trend, but in the U.S., and I think every country has its own little trends, like sub-trends. But I guess in the U.S., it's quite dominant. I haven't personally experienced it as much.
And I could see, like David, you were saying, there's all these kind of different niches. Some may or may not work, in a mall or long-term.
It's a question of how people identify, right? I mean, and so if you identify as a book collector, you're going to go to a book collecting club. If you identify as a pickleball player, you'll go to a pickleball club, right? And so people like to hang around in their own tribes with people like them, and that's the whole purpose of social clubs. If you have the cash and you can afford to do it, it provides both a built-in universe of friends or fellow travelers, and some exclusivity and places to go and so on and so forth. But and as I said, I think it's without question increasing, but I don't think this is a major real estate factor.
I see the advantages of it is because you're now getting these people to come in and for working out or something like that. And then the restaurant pops up. So now you have the social aspect, and it's bringing what was empty and vacant. People are coming in at least for a little while to do something. And so at least the owner of the property is bringing something in. Will it sustain? Again, if we have a strong economy and everybody's making money, it might become the new trend. Hey, I hang out at the old mall and I'm there all day. I go to the pool. I do all these wonderful things. But again, it's not going to be these type of memberships there. I don't believe they're cheap. David, I'm sure that there's an advantage to going to them that's up there. So again, you're going after a different target audience. And the great saying, location is key here as well, because you're not going to get it in the less affluent areas. And so what's going to happen to those build outs if they go that way? They're going to have to adjust and change and do different types of things. But for now, if it works, keep doing it.
Yep. I love the creativity. We'll see. Cool. Let's keep things moving. We'll go on to the next article from WSB TV Atlanta. City of College Park looking to get back $600,000 from real estate brokers. I read into this. I had to use ChatGPT to try to parse it out and figure out what what the issue was, because I was like, did the brokers do something wrong, or was it an oversight thing where somebody was saying yes to certain commissions? Yeah, go for it, David.
Yeah, no, this is a governance story. This, again, isn't a real estate story, but there is an interesting larger issue here. This was a question where in College Park, Georgia, the local planning group, the city's development authority, their BIDA, signed an exclusive agreement with a broker without having the authorization to do that. And whether or not there was malfeasance or nonfeasance, or whether where money was going, there were criminal investigations, whatever, ultimately the DA declined to prosecute, but there's a lot of politics going around here. So this, again, had to do with people doing bad things without oversight, or the very, very least mistaken things without any kind of oversight and governance. And so this is if anything, this points up the fact that development authorities and planning and permitting authorities in locations have a lot of power. I mean, I know certainly here in New York, what you can build is very strictly controlled by regulation and governmental oversight. And if there are problems with government or authorization or who does what, things can go south pretty quickly. But again, not real estate. This is a question of making sure, who can sign what, who approves what the whole process is.
It kind of seems like it's one of those examples of the right hand doing something that the left hand doesn't even know about and maybe doesn't even care about. And we're seeing this a lot right now. We're seeing the lack of government oversight where there's no real checks and balances. Somebody who didn't have authority went out and created an agreement with somebody to do business, and nobody on the internal side really checked into it. And there's a whole lot of those going on right now, it seems. It really kind of comes down to, it's reminding me of the daycare centers and these type of setups where somebody has authority to do something, but nobody's really checking into it to make sure that, hey, everything that's being done is proper and the taxpayers are not splitting the bill for it.
Yeah. Rezi, got any comments on
no,
that?
I mean, the city of College Park is definitely outside of my sphere of expertise, but I agree, obviously, with everyone here, Matt and Dave, that this is not an isolated incident. And I'm pretty sure if you dig deep enough in different municipalities and jurisdictions anywhere in the US or anywhere in the world, you will find things that happen due to compliance, regulatory, lack of regulatory oversight, or just mischievous activity. So I don't think this is isolated, and I don't think it just happens in one. And I don't think this is something that is a trend of it's happening more now and it'll never happen again, or it was never happening in the first place. So, but definitely outside of my expertise to comment further on that.
Yeah. All righty, let's go to the next article from National Mortgage News. Loan Think Urban Multifamily looks like the new subprime. Regulators are warning about rising losses and fraud risks in urban multifamily lending, especially in rent-controlled markets. Some are comparing parts of the sector to early signs of subprime style stress. Are any of you guys specifically in multifamily?
Yeah,
yeah.
I am.
That's all you're doing, right?
No, not all, but very much in multifamily, and sort of my history is in multifamily. And more than that, I live in New York, which is ground zero for the whole question of governmental rent control and intervention here. So this is a real estate story, but there are actually several intertwined stories that are going on here, right? One of which, so let's take them one at a time. One of which is the question of what is happening. Multifamily properties that were packaged up into, CMBS are all of a sudden having real problems, and something that looked like a surefire investment is going underwater, leaving government-backed programs in the lurch. And so there are a couple of different reasons, one of which that was, and the article, I think, conflated two things. One of which is the change brought by government regulation. So here in New York, for example, a couple of years ago, the state passed a ridiculously extensive change to controlling how multifamily apartments in places like New York could get rent increases, could be sold, converted, so on and so forth, which had the effect almost overnight of decreasing the value of the multifamily rent regulated portfolios in New York City by 10, 15, 20%. I mean, literally overnight because of government action. And so if all of your financing is based on future projections for cash flow and sales and so on and so forth, clearly that's a problem, right? But the other problem the story mentioned is mortgage fraud. And there have been several big cases. There's one going on in Baltimore right now, which is a big honking case. And it defrauds the lenders for that particular thing. But one of the things that we've seen is there's even a bigger challenge, which is because what was happening is people were inflating the valuation of properties to get these loans. And so the fact that they got the loan, they inflated the value, they got the loans, these became a standard now for underwriting other properties completely unrelated. So I've seen a situation here where you have a bunch of funds that were invested in properties in the same area that all of a sudden are in deep trouble because the valuations that they had gotten for their properties were based on what turns out to be fraudulent, bogus valuations for other things that was not in their portfolio, but that changed the whole market. So you have a change there. What this comes down to ultimately is that historically multifamily was a no-lose thing. It's a big building. It's got a long-term tenants. You will never lose money on multifamily. Yeah, but what this is showing is there are a number of cases, whether it's fraud or government, action and stuff, that can actually significantly affect this. And especially when you have government-backed securities, it's a challenge.
I see this as one of those things where we could talk about rent control because it is a big topic. And what's happening, I feel, in a situation like this is you have the rent control policies coming in, but you're not really able to compare it correctly with the insurance expenses, taxes, labor, capital costs, supplies, and things like that. And so there's a valuation issue that happens from the get-go, because the loans are usually going to be based off of, hey, what's the revenue coming in from the rent? And I think that's what we're starting to see with rent control problems is, hey, the value of it, because based off of what we're getting from the tenants and rent, is only this, so you can only get this much. But then the city keeps going up in expenses, taxes keep going up, and now you're left with a problem that sits there saying, well, I'm under now. How am I going to turn this into a profitable ordeal? The only traditional way is, well, I raise rents and I can cover my costs, but we can't do that now. And so this is what I expect to see quite a bit more in the future. We talked briefly, David said in New York, that's where you have a lot of stuff going on. And I think that's becoming a bigger part of the conversation because we've seen what happens when this type of policy comes in and it affects the whole investment community. Because if I know there's going to be rent control issues as an investor, and what I tell my investors is, well, hang on, we need to look much deeper into this. It's no longer that surefire, multifamily, huge ordeal, we'll make money off of it. Now let's see what the laws are going to be and let's wait.
As someone who was effectively born into multifamily controlled real estate, I can speak about this for the next several episodes of this podcast. But it's a real, rent control historically has never worked. The challenge is it is such a lopsided situation. There are more tenants than there are property owners. And so therefore, if you're a politician and you want to cater to the biggest number of voters, you say, your rents are too high. That's not good. We will cap rents so you can't raise any rents make it housing affordable. Well, that's great for the person who's in it temporarily, but what it means is ultimately there is no business, since real estate is a free market business, and you can't raise your rents. Nobody's going to build new buildings if they think they're going to be regulated or they can't do it. So ultimately, and there have been study after study after study that shows that putting in rent control has the ultimate effect of decreasing affordability, decreasing the housing supply, and it's just bad. It's absolutely bad economic policy, proven, except that it's politically expedient. expedient. And so New York City is currently under a rent emergency for the numbers. That rent emergency has been in place since 1945. So just to put things in perspective, you're talking about an 80-year, emergency. Well, yes, there is, but you don't solve this by taking one side of the equation and capping it.
And then what do you do now, especially in New York, you're seeing the eviction issues and things like that. Texas is pretty lenient with eviction. I've worked with clients. Go ahead, David.
But they're saying in New York that the only guaranteed way to live forever is to become a rent-controlled tenant, because rent-controlled tenants never die. The average age of the tenants in our rent-controlled properties, I think, is 85. So.
Well, and that begs the question. So there's a process here in Texas, not paying rent. We're going to go through the process and get you removed. Well, New York and some of these other states going into the thing, oh no, we're going to protect it. It's for the tenant. That's great. But now we're getting into all kind of constitutional issues of the fact that I own this property. I am renting it out. This is contractual based. Now you're telling me I can't do it.
You're speaking like a free market Texan. I'm living in New York where literally we just elected a mayor, a progressive mayor who regards himself as a democratic socialist, who campaigned on the basis of 100% rent freeze. I mean, his primary signature policy was, we will freeze all rents in New York City. And he was elected.
Yeah.
Now, that being said, whether he can do it, whether he should do it, whether he will do it, a whole lot of other stories in there. But just as an indication of the sign of the times, rent freezes are very politically expedient and economically disastrous. And even more so if you happen to be the property owner, they're particularly disastrous to you.
100%. And I think the issue from the investor standpoint is now, does New York, the great exodus from New York we're hearing about, I think that, yes, you will have that, because as an investor, I don't want to invest in something where the government is going to come in and prevent my incomes. But I don't think it's the end of the world. I think it's just a shift in who invests there. Does that bring in more foreign money? Because, hey, we're still making money in this aspect compared to where we are now, where, hey, there is no rent. We're now going to build, we'll invest. Yes, there are a lot of crazy rules. So we're still making money. Will that who is owning? I feel so.
That's a very interesting question, which actually leads nicely into the next article that you mentioned, James, about foreign investment in the U.S. and where that money is going. I mean, Reza, that's your wheelhouse. What do you see the money going into?
Well, I think international real estate investment into the U.S. is a drop in the bucket compared to the local market, to be honest with you. In the last, let's say, 1 or 2 years, I feel like the U.S. is aligning itself on specific, let's say, in the international sphere of geopolitics. So the political risk has increased for a lot of people. So we have the LATAM market, the Latin American market, we have the Far East market, we have and then the Middle East MENA market, Middle Eastern and North Africa market. Plus, then you've got the UK and Europe, right? We obviously see a strong demand from Europe and UK, but I think the US has sort of created a political polarization of the Far East market and also the Latin American market, just because of various other political factors that come in, where international investors, how secure they feel about holding assets, holding bank accounts, holding money in the US. Obviously, there's still a strong demand, but it looks like the US's market locally is significantly bigger, and the ratio of international investments, I feel, is still a drop in the bucket in terms of the big picture. We do see individual investors and families preferring Houston due to its very tax friendly and less regulated sort of investment environment, versus places like California or even Florida. But interesting enough, Houston, like Texas and Florida, do have nationality restrictions on who can actually buy assets in those states. So that's also a whole nother podcast on its own. But I feel like the international investment coming into US is, in terms of individual investors and families, has drop further as there's a lot more political polarization and alignments geopolitically, globally. And I feel like the local market itself is the main driver. It's not like other markets, let's say in Mexico or Panama or Dubai or Singapore, where the international money is the driver. I feel like that's not the ultimate driver in the US market.
Interesting.
I look at some of the investment routes and the DSCR I find interesting. I didn't know much about a DSCR until a couple of years ago when I started doing asset protection. And it wasn't really the locals who were utilizing it. It was mostly foreign investors coming in and purchasing up more rental properties. And since then, I've learned quite a lot. And while I don't feel they're as well known as the conventional paying cash, things like that, they're fantastic because it allows people to go out, buy multiple properties that are supported based off of the rental income. And it's still, I feel, more foreign investor type knowledgeable. I don't see mom and pops and, the cousin going out using the DSCR to buy multiple properties. Why is that? Maybe it's a tactic like, hey, look over here, you can come in and buy the property and bring in more outside money than keep it centralized. But it's these type of things that I think continue to push the real estate market when interest rates go up and things become harder for the locals to start adding more property. Is it disadvantageous? It depends on which side of the table you're looking at. But if you can learn to utilize these type of advantages and then get foreign money as well to help you purchase out, the sky's the limit.
Well, part of the challenge is that, as you point out, a lot of foreign investors are using DSCR because it's not necessarily income backed, right? So a traditional loan is you're looking at income back and they're underwriting the borrower as well as the property. And so there are a lot of foreign investors who can't qualify under the income world. But with the DSCR, you're looking at the property itself, which is fine. So it brings in more capital. The challenge is if there's something that happens to that income stream, all of a sudden those are the first properties that go underwater, and there's a real problem. And we're seeing banks doing some interesting things. One of the major developers we're working with, who has had a great record as a sponsor in terms of refinancing and upgrading properties, has got a bunch of banks who are delighted when they have to take back a DSCR property. They turn around effectively and sell it to him at their book value. So you have it written down from the original underwritten value to their value that of their note, and they sell it to him at 95% financing for that. So the bottom line, because that lets them not take the write-off on their books, which is good for them. He gets to buy with 5%, an enormous portfolio, and they're all betting on the fact that he's a good enough guy and smart, and so he can actually take this turnaround, improve the property, raise the rents, and hope everybody, keeping your fingers crossed, comes out the other end, right? So you're seeing interesting stuff like that happen when you have a DSCR loan.
Yeah, and I've never seen a bank unhappy about taking anything back. so that's the advantage with it. So where does these type of loans go? Well, of course, the way I look at it is if foreign investors are able to do it, they're able to come up with the ways. We as the local investors, local mom and pop type of things, take advantage of it and start using it, because once the door opens, it opens for everybody. And that's the type of thing that is advantageous about it. Now, of course, you can complain, hey, we don't want other nations coming in, owning up all the land. That's a whole argument on another level. But I think utilizing some foreign investments, it is continuing the economy to grow. Where it goes long term, that's up in the air. I throw that one back to you, David.
AI is a fascinating question. You want to talk about AI now, James, or do you want to?
I'll just jump in real quick.
Yeah,
if you guys don't mind, about the international investment side as well. So one thing is the DSCR in terms of individuals, families, or even institutions trying to get in. But there's also another factor on the international investment side coming to the U.S. is actually low interest capital coming into support developers developing real estate projects in targeted employment areas and rural areas. So the U.S., if viewers don't know, the U.S. has had a program called the Employment-Based Immigration Program, EB-5, since 1990. So for the last 35 years. And what it basically does is it provides cheap and patient capital for developers locally across the U.S. in return for investors to obtain their green card. In between 2016 to 19, it was about $20 billion was injected into EB-5 projects, which indirectly also had an effect of up to $70 billion, an economic effect. Over the last 10 years, there could have been, the estimates are anywhere from like $40 to $50 billion of direct investment just on EB-5, which supports the development. So you've got developers in Nevada, Atlanta, Florida, all over, developing, and even California, developing a major hospitality, condos, residences, master developments based on cheap money coming from from overseas investors in return for not owning the property, but basically in return of getting a green card from the USCIS. And right now, even though there is an anti-immigration feel globally, not just the US, the US is still rolling out the red carpet for anyone who has money.
Money talks. Money talks.
Yeah. So that cheap money is a driver for a lot of these development projects in specific areas, which in normal circumstances would not be able to make it a feasible project in terms of regular collateralized loans dealing with the local lenders and banks.
Reza, what asset classes are you seeing foreign investors into the U.S. market getting into, like single families, new development, syndications?
It's so diverse, it's difficult to say because you've got institutional investors, then you've got the families, right, that are doing that, could be more sophisticated, and then you've got individual investors. So that's the fragmented market where individual investors are looking for safe havens or a diversification, or potentially their families are planning to go to the US and they prefer to own real estate. So it's across the board, whether it's multifamily, resident, but for the individual investors, it's always plain vanilla. It's something more simpler to manage and understand, right? And to get into the barriers of entry. Obviously, institutional investors or family offices who have more, let's say, resources available to them, analysts, lawyers, they can source more, let's say, lucrative deals, whether it's strip malls or multifamily or some kind of, mezzanine loans to get into the commercial space. So it's very fragmented, to be honest with you. You can't just put your hands, finger on one area and say that's where all the money is going, because you've got an inflow of different sources in terms of the type of investors that are sending money over and looking to invest in the U.S.
That makes sense. Yeah. Same as here. All sorts of different levels, right?
Yeah.
Interesting. Anything to add to that before we take our break? All right, cool. That was interesting. All right, let's take a break to learn from one of our sponsors.
If you are serious about real estate and tired of guessing, you need to know about Real Expert Talks. This is where real questions meet real experts. As a member, you get direct one-on-one access to experienced real estate professionals. No courses, no fluff. Just focused video calls where you ask your question, get the answer, and move forward fast. 5 minutes, 15, or a full deep dive. You choose. One conversation can save you months of mistakes. And if you're an expert, this platform was built for you. Real Expert Talks lets you monetize what you already know. Set your own rates, control your schedule, get paid to give advice, build your authority, and expand your reach without chasing clients or selling anything extra. No middlemen, no noise, just expertise, access, and action. If you want answers, sign up as a member. If you have answers, sign up as an expert. Go to Real Expert Talks and turn knowledge into momentum. RealExpertTalks.com.
All right, let's get back to the news. From Newsbreak, $5 million payout in scale battle wine country prop mogul. $5 million civil settlement is a dispute between two business partners. A federal criminal case tied to alleged misuse of investor funds continues. Investors remain uncertain about recovery.
This is this is a scam, right? I mean,
Yeah.
just like the part of the problem with the other thing was governance and who signs what checks. This is outright, when you're dealing with private real estate, one of the reasons that returns are high and they are exclusive. Not everybody can access them. If you want to access things with total diligence, invest in a publicly traded REIT, which has all the full-on disclosures. But there's a reason you've got $2 trillion in privately held, professionally managed real estate in the U.S., and that's because it's definitionally exempt from the kinds of disclosure stuff that you need to do if you were doing it publicly. So that's why it's exempt, only because in theory it's being sold to sophisticated investors, people who are accredited investors or qualified purchasers, qualified investment buyers, who in theory are responsible for their own diligence. But as cases like this have shown, not everybody is capable of doing the kind of intense diligence with the kind of transparency that you might expect in other kinds of investments in other markets. That's one of the reasons of what we're doing in US REM, is creating this effectively a marketplace for people to invest in professionally managed real estate. So instead of buying properties, you're investing as an LP. And we are, given who's involved with this operation, are so completely focused on making sure we're dealing with the right kind of people, that we are looking to make sure that everything is clean. And as an investor, if you're investing in this space, you have to do your diligence, because otherwise, as this one example shows, there can be a whole lot under the covers that you don't know what's going on.
Yeah. I've been involved in a couple syndications, and one of them was non-accredited, one was accredited. And either way, we were providing a layer of due diligence for them, which was pretty valuable, because even accredited investors don't necessarily know how to run the due diligence on these deals. So it was important. I was going to mention, I thought I'd heard that they were going to change the definition of accredited investors. Have you guys heard that?
Yeah, this has been an issue. This has been an issue for years and years and years. Just to set the groundwork here, in the United States, anybody can raise funds to to sell equity, sell shares, ownership shares in an enterprise or a fund or whatever, to anybody you want. ... if you file extraordinary disclosures and everything is totally transparent, and that's a public offering. The SEC requires that you have comprehensive hundreds of pages of all the risk disclosures and everything else. So if you want to sell shares in your company or your fund, no problem, just do that. The problem is doing that is ridiculously expensive, extraordinarily time-consuming. The markets aren't there. It costs millions of dollars. And so that obviously doesn't work if you have got a small fund, or you're one building, or you're starting up a startup company. And so therefore, the SEC has provided for many years an exemption to that public registration and transparency stuff, which says that, okay, you can take money in and sell to people without going through that whole giant public offering process if they are a certain type of player. And the historical definitions there have been, if they are a person who has over $1 million in net investable assets, not including the value of their primary residence, their home. So you have to have either a lot of money you can afford to lose, or you have to have at least $200,000 a year in personal income, or $300,000 if you file jointly with your spouse, on a steady basis. So that says, okay, you got enough cash. Even if you lose cash, you have more cash coming in, right? And the third one that they recently added, that was added in the Jobs Act, or actually 2 years ago, says that if you are sophisticated, which is a proxy, they're saying if you have an SEC registration as an RIA or a broker dealer and you pass the SEC tests, then you're considered sophisticated. So those three groups of people, plus institutional investors, people who are managing over 5 million in assets and so on and so forth, banks and the like, those people are allowed to invest in these private funds and private companies without a public registration. And so the question has always been, well, why should the big people be allowed to invest in these highly lucrative things? Why can't the little person invest in that? And so on the one hand, there has been a lot of pressure for a number of years saying this is not fair. Regular people should be allowed to invest in these high growth, venture capital and startup and private real estate funds and stuff. But the challenge is that there is a reason those requirements exist. There's a reason you have the Securities and Exchange Act and you have public registration to exactly avoid this whole thing about, stuff happening under the covers that you can't see. And so having a publicly listed vehicle doesn't guarantee that it's clean, but what it guarantees is you got transparency, and if something is going on, it is as likely to be picked up as not, right? Whereas in the private world, it's a big dark pool happening in the corner with no disclosure. And so I am not a great believer, by the way, in case you haven't figured that out, in extending the definition of accredited investors and reducing those things. If anything, it hasn't. Those numbers of 1 million and 200,000 have not actually changed in a decade, and they probably should be raised up a little bit, not down.
Yeah. I'm curious. Oh, go ahead.
Well, I was going to add that's something that I see a lot. It's the transparency. My background, I actually got into the financial world doing private equity deals. I got licensed. We started doing private equity deals, and you had the rules under Reg D and things like that for accredited investors. And then I got into the financial advising side after Lehman kind of went down and my equity trading industry ended. And what we're seeing now is investors want more when they're sitting with their financial advisor, investment management manager. They want more than, hey, just stocks, bonds, mutual funds. They're wanting to get into private equity. And I like the fact that the industry is finally coming out with syndications, private equity options for people who are not in the family, kind of the family offices. So now the guy who has never really done it before can do it. And so we do a lot of syndications and things like that for tax strategy. We'll find things for depreciation, stuff like that. And even today, it's more along the lines as, hey, we're just pointing you in the direction. We're not going to do it. And the problem I see so many times is the due diligence issue. They want the investments. They want the advantage for the tax. They want to invest in something that's not just a stock, a bond, a mutual fund. But a lot of them don't want to do the work and the research that comes with it. They don't want to sit there and evaluate who is actually doing the deal. What is the realistic returns off of this? And so it becomes a problem because if something goes wrong, it's a lot easier for them to lose the money and a lot more money in that fact, because it's more steps and more work to it. And so I also agree. I think the number for accredited investor, I don't know if that matters if it changes. I think the educational aspects has to be brought out further, because a lot of people who have never done these type of investments are now doing it and they don't know where to begin. And you're having issues like this where, hey, there's a big ordeal that happened. There's a $5 million civil lawsuit coming in. Well, that's not the investors' aspects of it. They have to now come in and sue after that. So is there going to be anything left after that? You don't know. And now this little deal, hey, I'm putting in $2 million into a non-common, we'll call it, investment scenario. I've lost that money, and now I have to spend even more money to try to get a portion of it back. To me, it's not about the amount of money. Of course, you have to have the money. Like, if this deal goes bad, will you survive? But it's more, how do you go and verify this is legitimate? What have you done? What are the steps you've taken so that you know what the real risk is?
Yeah, I know with syndications, like the biggest challenge is just education. That's why most syndicators have these boot camps and people come in and learn kind of from the ground up, like
But
how these are.
ultimately, we're going to see more and more clarity. We're going to see more and more standardization. And as things get standardized, and as there's more AI involved, and as there are more platforms, you will get more transparency. You'll get more normalized ability to compare A and B. You'll have more metrics that are publicly available. So I think that the trend here is a positive one, just the way the market is moving.
I just want to agree with Matt and David on this, is that it does sound super lucrative when you get into all these, private equity or venture and syndication deals. And an accredited investor, as David outlined, the regulations is across the board in North America. That's the definition. But my 2 cents on this matter is an accredited investor. So if somebody wins the lottery, they're an accredited investor. Why? Just because they have money? Does that mean they're actually like an investor or have any knowledge? Or two, somebody gets a divorce and has, or an inheritance, and they have all that money. Is that an accredited investor again? So it's a very interesting definition. And then going back to that specific article, James, in terms of the wine country fraud, I always say there's well, everyone knows there's two industries that can turn a billionaire into a millionaire. One is wineries and one is airlines. So any syndication or any investment deal that has the word wine in it in there, I mean, some people have to be well aware and read the fine print, to be honest with you. So I'm not surprised that something like that has happened.
And to add to that, as the boomers are retiring, passing away, that big amount of money is flowing down to their children or their grandchildren, and it's big sums of money. And I find the trend is they're not as interested in the traditional ways we've done business of having advisors. They want to do it on their own with a little bit of help from the side. And that's what I see heavily coming in the market, is somebody young with no experience saying, I want to save all this money on taxes, and I want to do private equity, and I want to do things that aren't traditional because that's the way I want to do it. And that's what's popular right now. Yet they have absolutely no understanding of simple finance. And the question they always ask is, well, will you go find it for me? No, you have to find it. I'm not finding it. I can point you in a direction, but you have to make this decision on it. And the decision making sometimes is horrible because it's lazy, and it's oh, the market's hot. Oh, it's big right now. Everybody's buying real estate. I'm going to put all my money in this real estate. I think
that's actually an area where hopefully we can make some kind of inroads with US REM. What we're doing is creating a marketplace for private investment in real estate. You got to be an accredited, minimum as accredited investor, but we're really aiming at QIBs, qualified institutional buyers, qualified purchasers. So that's 5 million. It's even a higher bar than the standard accredited investor. But there you'll be right now we have 4 or 5 dozen types of properties there, and with hopefully some types of standardization, people will be able to compare A, B, and C and make their own decisions with appropriate support tools and the like. So in order to do these kinds of things intelligently, you need to know what the market is. You need to have a bunch of things to choose from. You need to be able to know how to analyze A against B, and then you make an informed decision for yourself. And again, I think the trends are all heading in the right direction for that.
Correct. And more stories like this, what it's going to do is it's going to bring more government involvement, because they're going to try to prevent these type of situations happening to a whole new generation of people and require stricter demands and more transparency, I feel, on the equity side, selling these type of deals to people.
All right, guys. Anything else on that? Let's go to the next one from CNBC. Hamptons real estate prices hit record with 2026 summer rentals going fast.
Nah, that's not. This is actually really, it's a slightly mislabeled. And technically, is it accurate? Yes, but the problem here is it's a mixed change. In other words, what's happening is people are buying more of the upscale stuff than the lower scale stuff. So yes, there is a change, but this is not a big real estate story. It's local to the Hampton market, which is a weird market all by itself, and it has to do with mix. I would say this is even worth talking about. Let's go on to the next subject so you can wrap it up, which is a really cool one that we want to talk about.
All right, let's do it. From Bloomberg via Yahoo Finance, real estate stocks sink as worries about AI risks spread. Commercial real estate stocks dropped as investors worried AI could influence office demand. Some analysts call it an overreaction. Others say it's early repricing. Take it away.
I could talk about this for hours, so let's hear it from either Matt or Reza if they want to chime in before I monopolize the conversation.
Yeah, I mean, I'll give my 2 cents on the matter. So, did we see office and commercial real estate like vaporize in the dot-com boom? I mean, with the internet and everything. No. So this is basically, from our point of view, it's a investor sentiment, and it's obviously a big hype. And basically, investors are punishing these types of, let's say, this category investment in the capital markets just because it's not AI. I've spoken with several wealth managers of these larger banks here up in the north, and they've been flooded with investors coming and investing in AI and shunning the real estate market, because in certain markets up here, things are quite bloody in terms of the real estate market. So a lot of money is going to AI. There's positive sentiment. It's taking over all the news headlines as we see. Even this conversation, half of it's about AI. But the matter is, it's just a general investor sentiment. It's a public, it's a massive trend right now, but it doesn't mean that people are not going to need commercial real estate or offices. It's never happened like that. We've seen that with the internet boom and the dot-com. But yes, certain stocks in that industry are going to be punished just because they're not in AI. And they're going to come up with, the analysts are going to come up with multiple reasons of why to downgrade it or to reassess our pricing. But at the end of the day, real estate will remain real estate. No matter if we have like super AIs or Star Wars going on, real estate is tangible and it will remain. That's my little input on there. But David and Matt can come in.
Matt?
I think there's more to it than just AI. And this article forgets about the big thing that happened in 2020, which was COVID. And everybody went to work from home. And it became normal for an investment manager, for an attorney, for tax people, for everybody to sit at home in their boxers, with a nice shirt on top and do business. The clients got used to doing that. The clients don't want to get up, drive through traffic. I'm here in Houston area. They're like, no way. Nobody wants to meet in an office anymore. So what's that done? It's shifted it to, okay, let's go online. Let's start doing things where we're able to not have to drive anymore. That has become popular. I can't get clients to come into the office. Now, do I have an office? Of course I have an office, but I no longer am going to go for that big overhead office type. I think what's becoming more and more popular are the Regis type offices and the rental offices where you have an office, you can pay for it, but you're not buying the whole building and using it anymore. The other issue is that with AI, and this is where I feel AI is really affecting it, is before AI, you would hire assistants, you would hire other people to help do that work. AI is now coming out doing a lot of these type of work. So we're not bringing in as many employees to help service. So that means I don't have to put these people somewhere anymore. And the ones that I do bring in, it's also the type of ordeal. Well, you can work from home. I don't mind. Just get the work done, be client facing when you need to be. And so there's a lot of situations that are taking place. I don't completely blame it on AI. I think it's just the shift on the market is a lot of people no longer have to go out and get these commercial properties anymore to be storefronts. Now, if I'm selling products, yes, it's probably good to have it. But for services and things like that, I think that the trend is started with COVID and it's just continuing that line. And maybe they're blaming AI for a much bigger shift that took place much earlier.
Good point.
All right. So both of them are absolutely right. And there's a third piece here. So this is a great way to sort of wrap up this discussion. So first of all, Rez is right that the immediate big drop and so on and so forth, this is totally an investor sentiment question, right? It wasn't that people are not going to be using offices. What drove this investor drop in demand for these real estate stocks was that, AI is going to take all the jobs, and not that people are going to be working from home. People aren't going to be working. If there's nobody's working in a white collar job, nobody's going to need offices. And so the sky is falling, the sky is falling. So the right church, wrong pew. Yes, AI will take over all of these jobs, but those are the jobs that will remain are effectively white collar jobs. There'll be a question as to what extent of what blue collar jobs are left. But these white collar jobs will be different white collar jobs. People will be using AI to do things. And so the question is, as Matt pointed out, where are they going to be doing it from? And what will an office designed for this new world look like? Will it be a WeWork or a Regus or a drop-in space? Will a third kind of space? How will this impact things like the social clubs we talked about earlier? How will people be moving farther to the suburbs as you have autonomous vehicles that can take you from a city center to a home in the suburbs? What will that do to real estate values? So AI is big. It's really, really, really fundamentally big and game-changing for society to an extent where, not going to get into a whole bunch of prognostication, but you are going to have significant double-digit total job loss within the next single-digit years. And that's going to basically rebuild society in some way. Another story. So it's big. It's happening now. It's really fast. Just in the last 4 weeks, with the introduction of the latest models from Anthropic and OpenAI, game has changed, order of magnitude more powerful, and we're seeing this across the board in every area. So therefore, this change in society will affect real estate, but it'll affect what is built, where it's built, how much it's built. Like Reza, I agree, you will always need, as long as we have physical corporeal beings, as long as there are 8 billion people who exist on the planet, those people have to live somewhere and they have to physically work somewhere. It may be the same thing. It may be an expanded home thing. It may be, who knows what. Maybe it's an office that with hoteling where everybody in the company works a week, a month, and there's a hotel attached to the thing. Who knows, right? So there's going to be a big change, and we really have to be cognizant of that and think about where that is going. But the current thing about, quick, let's dump all of our real estate service stocks because of AI, that's a sentiment thing, and we will hopefully get over that.
There's a lot of articles that just appear to justify why a whole sector is going down. And I think this is one of those articles that maybe valuations got too high. Let's bring it down a little bit and let's justify it through a news article and a storyline. Rez is absolutely right. And David too, in that manner. Real estate's not going anywhere. It'll still be there. Now, how it will change, that will be interesting to see. I think the main concern most people think about when talking about AI is, where am I going to be in the next 5 years? What is my job going to look like? As when we came in and we were talking, I was discussing with you guys, I better get into litigation because the whole AI can do it. It can do it better on a lot of factors. And I think it doesn't completely remove jobs and industries. It just shapes them and it makes them more efficient. And you have to stay ahead of it, or you will end up without the job, and you will have to figure out, what am I going to do to make money? There's a joking episode of South Park that talks about how the plumbers and the electricians and all those people are now the multimillionaires because nobody knows how to do that. And that's the demand in the future of what the money will be. And so it's pick a hobby now that you start liking and learn electricity along the way, because it may be your future role.
So true.
I think maybe they even used AI to polish those articles that they're publishing. So there's a bias.
Yep. We use it to grab them and form these questions and stuff. Yeah. Well, let's go to our next article from Fox 26. How do you say this, Matt? Houston?
Friendswood, which is located kind of in the Houston area. Yeah, the title on it was wrong, so I didn't catch it at first. But yeah, that's a typical Houston situation.
Yeah.
Yeah, but with all fairness, that's happening in New York as well. There have been several cases in New York of people doing this kind of stuff, right? And this is basically malfeasance and bad intention and bad actors. Part of the challenge, it's not that we don't know how to solve this problem. It's a question of the political will to do it, right? I mean, title searches. For those who didn't read the article, there have been several cases where people are doing deed fraud and stealing other people's homes by going in and filing that they own this house, and they do a fraudulent transfer. And the real owner wakes up one day and finds that there's no house there. And they're doing it when people die. They check the obituaries and go in and forge a deed and so on and so forth. So that's just this illegal, bad stuff. But what it points up is the title insurance has to up its game when you do a transfer, and you need to have we have the technical ability now to do appropriately searchable, blockchain verified title things, and you're going to see this. There's a lot of stuff happening under the hood. It hasn't taken hold yet in the real world, but it will. And I think within 5 to 10 years, we're going to see all kinds of title on chain. We're going to see all kinds of more better safeguards and tech driven solutions in place. So I just think we have to have the political will and will as an industry to actually implement what the technology currently allows.
Yeah, we like every month we have some deed fraud thing. I'm in it on this residential side. Even within our brokerage, we're like training people to like coach their clients to this is specifically for wire fraud, like take these steps because this is happening over and over and over. And then you have things like this article where they're trying to steal dead people's homes out from under them. It's crazy. But yeah, we have to. Yeah, I think the blockchain is going to really help. And, in one of these other articles, it was talking about double pledging. How is this even happening? I mean, obviously there's forgery going on, but, we've got to get solid title searches so that kind of stuff doesn't happen, So
one of the things, so I've seen this happen to several people, and what I like about the Senate Bill 1734 is that it's going to make the process easier, because right now, if this happens, this is a major issue where you can't sell your house, that they show up and evict you from your own house if the circumstances arise. So it's a major ordeal. I've got quite a few clients who have reached out to me about these type of things over the last several years. The making it easier, what was it, 30 to 45 day court process is definitely a step in the right direction, but it's also an awareness issue. I now have several clients who have gone and gotten you can go into the county usually, and you can sign up for alerts involved on that property. And so one client in Montgomery County, he gets alerts. And so we did a deed transfer into a trust, and that was the first thing they actually saw, an alert, and he was all excited because now he knows, hey, if somebody tries to do something with this property, I'm going to be alerted. And so it's a nice security type step in the right direction. But I think more and more counties need to implement this. You do see programs. I think LifeLock may even cover something like this, where they'll alert you if something like this is happening. And so it's something that as more and more people become aware of, I think it becomes less of a issue because the right steps are put in place. But I've seen it happen. It is a nightmare to battle with, and it's an expensive cost because now you're having to go into a whole process. A lot of people have to get the attorney involved. And so you went from everything's fine, I love this house, I'm living here gratefully, to, oh, well, I no longer own it on paper. I'm worried I could be evicted from my own house. Somebody else could sell it, completely screw up chain of title, and now I have to pay for all this. So I'm glad it's finally coming to light more and more.
Yeah. Reza, are foreign investors investing in the U.S.? How are they looking at this? Because, I mean, we all live here in the U.S., and we're trying to get our heads wrapped around, like, how do we protect ourselves and our clients? coming from outside the country. Like what?
Yeah, I mean, I think this is very localized. Obviously it happens in little pockets everywhere. I can't comment to this specific incident that's been reported. For international investors who are investing, they just have trust in the U.S. system. They're at the same disposal. At the mercy of whatever security and safety is for the investor to hold property. So they're not in any way at an advantage. If anything, they're at a disadvantage. And probably if they read more of this type of news, they'll probably be scared off. But what I can say is here up in northern of the U.S., the 52nd state, we have a pretty streamlined system in terms of title transfer. And I always say, make sure you owe the bank even $1 on a mortgage, because that's going to be your security. If they do something wrong, you sue the living hell out of them, because you've got a third party that's liable, and always having a bank on title, even if you owe them $1, is the ultimate security for such fraud. I'm not saying it's foolproof, but that's what I always say and advise my clients as well.
And to add to this real quick, a lot of these homes are being discovered during the probate process, where, okay, you're memorializing with the county, it's public record where the decedent lived, what all their assets were. So now there's an easy list for thieves and people doing nefarious act to, okay, this was somebody living by themselves. This house is now just sitting there. And so I think a lot of the protection can come with the typical estate planning aspects of build your estate so that you're avoiding the disclosure of this information by using trusts and things like that. So now you're not having to file all this information that's public. And I talk to people all the time. Remember what you're doing when you do the will is you're making everything public now. So don't talk about, I'm giving my son who's 17 years old, $5 million, because the next thing you know, he's going to have 20 new friends who he's never met before hanging out with him. So use the estate planning aspects of it to protect your assets going forward and keep it out of the public knowledge.
Gotcha. My mouse stopped working. I can't get around. Anything else to add before we take a break? All right, let's do it. Let's take a break.
Are you looking to elevate your business through exceptional content? Universe Media Publishing is your gateway to success. We understand that in the world of business, content is king, but not just any content. Your business deserves content that captivates, convinces, and converts your audience into clients. At Universe Media Publishing, we specialize in crafting SEO-rich web content, persuasive copywriting, and marketing copy that resonates with your audience. We don't just write, we engage, we connect, and we deliver results. Imagine your brand's voice amplified, your message crystal clear, and your presence dominating the digital landscape. That's the power of partnering with Universe Media Publishing. Don't let your business just blend in. Stand out, be heard, and make an impact. Connect with us at Universe Media Publishing, and let's turn your vision into reality. Visit universemediapublishing.com today. Your story, our expertise. Together, we'll create magic.
Okie dokie. From Fox 11, Los Angeles, Burbank man's $1.5 million home sold without his knowledge in elaborate deed snatch scheme. Sticking with the theme here.
I think we just covered that one, didn't we?
Yeah. Let's keep going. All right, here we go. We're getting into David's world. Secondaries investor. Real estate secondaries volume reached a record $20 billion in 2025.
That This is a big story, and it's a real story, and that's exactly what we're doing and why we're here. So for those who haven't been focusing, if you're thinking of, if you just know real estate in terms of either flipping or buying a property and holding it, a secondary transaction is one in which somebody bought the real estate or bought a real estate interest and then resells that. That's the secondary sale. The first guy was the primary, the second guy is the secondary. And so typically in the case of real estate, that means if you've invested in a real estate syndicate, a club group, or a real estate fund, typically the deal there is it's a long-term investment, long-term capital. The pro forma you looked at says showing 5, 7, 10, 12 years holding, and LPs are not allowed to resell their interests. So you're stuck effectively in there. But so in the real world, even though everybody goes in knowing that it's going to be a long-term hold, and they're comfortable with that, that's why they invested in the first place, for the higher returns. In the real world, life happens. And in America, typically that means you're getting divorced, or you're dying and your estate has to deal with it, right? Or you somehow have a capital call from someplace else that came out of the blue and you got to get liquid. Or if you're in a smaller institution, you want to do portfolio rebalancing. So in any of these cases, you take a look you have this big real estate chunk sitting there and you say, oh, well, that's a great piece. And you go to the GP and you say, hey, I know it was a long-term investment and I said we were in it for the full time, but I really need the cash now. So can you please buy my piece out? To which the GP typically will respond, I empathize, but no, that's not the way this works. It's long-term capital you cannot sell. So, good luck holding it, right? And if the LP makes enough of a stink, eventually, typically the GP might say, okay, listen, don't make a stink, but although I don't have to approve it, if you can find somebody to step into your shoes and buy your piece, I will okay it, even though I don't have to. And so then you have effectively, a random person with a random piece of a random syndicate trying to find somebody to step in and buy their piece of something that can't be further resold, which is a problem. But the LP can't sell until the maturity date. But interestingly, the fact that there's a maturity date means that at that point, at the end of the 5, 7, 10, whatever year period is, the GP is required to sell the property so they can return the cash back to their LPs. So what happens if you come into a market like, right after COVID or something, where there is no market, where you cannot possibly sell this building for anything approaching its value? In that case, the GP has got a problem. They have to sell it, but they can't. So in that case, what a GP does is a GP-led secondary, also known as an LP replacement, where they either will come up with a new fund with new investors that will buy out the old ones, or they'll try and arrange a sale of pieces from LPs who want to get out to new LPs. But that's a very complicated process because it's a non-trivial, it's not a natural process, right? They're doing something that they weren't expecting to do. Costs hundreds of thousands of bucks, takes a year to do. And the bottom line is nobody ever wants to sell a real estate secondary, neither the LPs, because they were, in theory, were in it for the long haul, nor the GPs who, are faced with, having a problem because they can't sell the property. And so therefore, in terms of real estate, secondaries have always been it's a bit of a distressed asset, right? Because somebody has to sell. But what's fascinating is that what the has to sell piece comes from the buyer side, the holder side, not necessarily the property side. In other words, you got a perfectly good property, but if the LP has a liquidity need for some completely separate reason, like they're getting divorced, that's nothing wrong with the property. It's from the challenge for the seller. There is another secondaries market where a very different feel goes into play. If you go and buy a share of Apple or Microsoft, think about that. You're actually buying a secondary. Somebody before you had bought a share of this public stock and is now selling that. So when you're looking to buy a share of Tesla or something, you don't say, ho, I can get a good deal on this because Matt's got to sell it, right? You say, what's it worth to me? And that's the offer I'll make, right? And so there doesn't exist that in the real estate secondaries market, and it's really tough and challenging with no marketplace or anything. despite that, what this article is saying is that in the last year, $20 billion of this completely unsellable real estate secondaries changed hands. About 70% of that coming from GPs coming to the end of their rope and having to do effectively a refinance, an LP replacement, and the other 30% coming from LPs who needed liquidity. And right now, the average discount off of NAV, net asset value, on these things is about 70%. It turns out that if you have a really big portfolio, you have a $500 million portfolio, there are large multi-billion-dollar secondary funds from Blackstone and Ares and so on that will buy those out, typically at about a 25% discount. On the other hand, if you were an individual person with a $500,000 investment in a local syndicate that owns one apartment house in wherever, good luck trying to find a buyer for that at even 40% off of NAV, right? So there's a challenge, and that's the problem we're actually solving at USREM by creating the first marketplace for these properties. And so therefore, we work with GPs who have a property, and the GP effectively lists the property with us. Doesn't cost them anything, but now all of the LPs in that property have the ability at any point to say, here's what I want to get for my piece, and then anybody can come in and effectively make an offer against that property to buy a piece. So you basically have a marketplace where we're a broker-dealer with running an ATS, alternative trading system, where you can actually buy into these secondary pieces and make it much easier to sell and to buy. And if you think about how much space there is in this universe, the public stock markets trade of the market cap of value of everything traded in the marketplace, that actually trades about 150% of the value every year. But that $20 billion in real estate out of a $2 trillion privately owned, professionally managed real estate is 1%. So think about the headroom there is here in terms of what actually could happen, because this is a way to get liquidity for people who are in real estate now. So hopefully we're going to, we're just coming out of the woodwork now. People don't really know we exist. We're just really spinning up. And hopefully this will be the beginning of a very new, interesting market.
Thank you for explaining that. And now I have a better understanding of what you're doing there. That's cool.
So we have,
okay.
we're just launching now. We've got about $3 billion in total of properties, and they range from affordable housing funds to portfolios of market rate, Class B properties, to new construction where a new seasoned developer is effectively syndicating a major, trophy property in Midtown Manhattan, to triple net leased retail where people can invest in effectively almost a bond-like, cash flow. So there are a wide variety of things. It's all real estate, only real estate, no private equity or venture stuff. So it's only real estate, but then this is designed for the very high end of the market for, qualified purchasers and above. And so the typical transaction size is about $1 million kind of thing where you're making an investment, but it provides a way for people who are in these existing properties working with their GP to get liquidity, and people who are looking to invest in this for the first time to actually have a place where they can go to compare things, get the education that Reza and Matt were talking about before. So hopefully it'll be a very interesting play.
Yeah, your timing's good, because I know a lot of syndicators got upside down with rates.
As an indication, just before the holiday, we sent out a few thousand emails to real estate investors saying, "Hey, we have this thing here. If you're interested in buying, real estate secondaries, let us know." To my astonishment, 100% of the emails we got back the next day were from sponsors saying, "Oh, wow, can I put my property? I'd love to get liquidity. Either I have a GP, problem at the end and I'd like to turn my thing into an evergreen fund, or I have LPs who want out. How do I list?" And since it doesn't cost the sponsor anything to list it with us, I think this will be a pretty fast-growing thing. So
there's definitely a trend into it. I'm seeing that more and more. Again, kind of as I mentioned, you've got a lot of new people coming in, and that's what kind of the secondary market is alluding to, is this isn't something you're going to buy and 3 months from now and decide, you know what, I should have bought Apple stock instead. You're going to be
day trading.
Exactly. And so for the right investor, it's a fantastic opportunity because you're getting something different. Usually they come with high returns. A lot of the syndications that I see have tax depreciation strategies and things like that. One of the things I always talk with people on this side is the misconception of the GPLP. And this is more of that educational aspect, is the limited partnership. And, oh, I'm a limited partner, I'm protected in it. Well, you're protected to your investment, but that's not what really happens. And so when I first really started seeing these type of deals on the secondary market and just in general being sold, it was because we were building out structures to protect the asset itself from personal liability. And so I got to see quite a lot, and a lot of people would come in and say, oh, there's no risk to its limited partner. And the conversation wasn't, no, that's not what limited partner is. Yes, that money to that extent is all you're risking, but what if you get sued? What if somebody comes after you? This is an asset just like all these other things, and you need to protect it. And so I learned more about the whole setup, the syndication aspect, because I had to build out LLCs and other protection type of strategies to put this into it, so that if you are sued, you're not having this property taken out. And it's funny how we learn about things, because it's usually something that has nothing to do with it that leads you to this whole new market of amazing strategies and ordeals. But this is the future. I think a lot more people are going to start doing this. A lot more people are interested in this type of deal because the returns are better, or there's depreciation models and allocations and things like that. But again, there has to be the conversation that this is more than just buying a stock. You need to do the due diligence. You need to understand what you're doing, and you better check out who is running this ordeal, because you're going to end up like 2 articles ago, where everybody put their money into a deal and it went south because nobody did the transparency and looked into it.
Absolutely. This is very much, remember, all of these secondaries and everything we're doing is working under these exemptions for people who are sophisticated players. This is not available to retail investors, right? And in our case, we're really focusing, as I said, at the qualified purchaser layer, which is even above accredited investors. So you're talking about people with big checks and big money and relatively few guardrails. I mean, obviously a platform like ours is going to do what we can in terms of trying to be rational and diligent and so on and so forth, but it is very much caveat emptor, buyer beware. You have to, because you are exempt from these regulations, you or your personal advisors have to be very sure about what you're getting. Deal with reputable sponsors, make sure the numbers all work. That's why it's exempt. So
you don't have any 506B deals on that platform?
No, these are all 506B or 506C. Not 506B. So that they're all, in other words, 506B are all for accredited investors, right? You can't, they're not for retail investors. I mean, they're asterisk. There are, you can put in 20 or whatever, 30 retail investors in a 506B if you do the equivalent of a public offering, but people aren't doing that. So effectively, no. So yes, this is designed for, those are exempt offerings. So these are not for retail investors.
I guess I'm unclear. So
506B is an exempt offering, which means the reason it's exempt is because the person who is investing is classified as an accredited investor or a qualified purchaser. So retail investors, you can't just say, I'm setting up a fund. Anybody on the street want to come and invest in here? If you want to do that, then you got to be a public offering where anybody and their brother can invest on the public stock market. You can buy a share of Apple regardless of how much money, who you are, or anything else, right? Because they have all the guardrails in place. But if you want to invest in a private real estate syndicate or a startup company, right, or a hedge fund or whatever it is, the only way you can do that is because it isn't listed, is if that transaction is exempt from regulations, and the exemption is 506B, says that, okay, if you are an accredited investor, then you are exempt. So that's what it's doing. It's not, 506Bs are not for retail investors; they're exemptions.
Correct. Very similar to 504s offerings and things like that. And the exemption is really kind of when we first got back into it 20 years ago, we were doing 504 offerings and things like that, where all the investors had to be accredited. But the advantage of it was you didn't have the nightmare of the filing and the regulations that came from having to put this deal together. I think David alluded to it earlier. And so it makes getting deals off much, much easier. But there are certain rules that, hey, because you're not having to do all these regulations, here's a list of things that the investors have to qualify for. You have to at least do these type of things. All kind of, it's a few steps shorter, a lot easier to get deals out, but you got to follow the rules. And that is one of the things, of course, is you can't show it to unaccredited investors. Well, you can't sell it. I'm sure you can show it.
Under 506B, you can't even show it. 506C, you can
Oh,
sell
really?
it.
Yeah.
But you can't sell it. 506B is even more restrictive. Yeah.
Yep, for sure. Well, should we go to the next article? All right, from El Paso Times. El Paso accountant gets prison in $600,000 real estate business fraud. He was peeling off.
It's just real estate porn. I mean, it's a standard embezzlement story,
Yeah.
So, $600,000 from fun because nobody was watching what checks she was writing. Again, this is an internal oversight question. And one thing, the leitmotif that keeps coming back in all these stories about fraud, misuse. I think we've discussed 4 or 5 stories, right? Either a government official is doing something screwy, or a thief is doing deal fraud, or somebody is embezzling, from here, or somebody is screwing their GPs. All of these go to show that people are not perfect saints. There are people who have problems and who do bad things. And in private real estate, there is a lot of money sloshing around because it is private and not registered public investment, a lot looser controls, transparency, and everything else. And so all this basically shows when a lot of money is at stake, make sure you have transparencies, make sure you have controls and auditing and so on and so forth. The fact that this, woman in this particular article ran, 4 years across 6 companies, writing checks to pay her credit cards and, whatever, that basically somebody wasn't looking who should have been looking.
Yeah. She's in a position of trust as the CPA and was not trustworthy.
That becomes one of the questions here is what should happen to licensed professionals when they do this type of stuff. And I think having that fiduciary responsibility, that role where I'm not assuming my CPA is going to embezzle $600,000 from a deal. What happens when they do? Well, she's going to prison. I'm pretty sure she's going to lose her licensing.
Yeah, she's going to lose it all.
And I think the key here is that I'm learning that I better be very careful with doing real estate in Texas because we keep popping up on this news article list.
You guys are shady down there.
I'm telling you.
Let's go to the next one from the Wall Street Journal. Via MSN, lenders to commercial real estate owners, pay up now. Office loan delinquencies hit record levels as refinancing challenges persist. Billions in CMBS loans are past maturity, increasing pressure on lenders and regional banks.
Yeah, this is the same story we discussed a couple articles back from a slightly different perspective, right?
Yeah.
With the write-ups in there. And it's a serious one. If there's one sort of overarching thing about this episode, I think the combination of AI and market changes and government-backed, securities, CMBS, and so on is the interesting one. And this one deals more directly with the question of what is real estate going to look like, real estate office and stuff in the future. And I would throw in from a different direction in the same way that AI is changing jobs and changing the way people work commercially. The advent of autonomous vehicles, robo-taxis and cars and stuff, is going to mean that you don't have to live in the city center if you even wanted to go into the office, right? You could live an hour or 2 hours out of town and have, get your cup of coffee and get in your pod, and your pod just drops you off right in your office, if you wanted to. So I think that's going to change residential stuff as well. But this particular one, our story is talking about office stuff. And it's partially the scare sentiment factor that Reza mentioned before about, the AI is coming quick, nobody's going to work, and there won't be any need for offices. I think it's much more nuanced than that. And I think it's a question of what will the offices in the future look like? What will that have to do with newer construction stock designed for that? I mean, JP Morgan Chase just built a mega skyscraper in the middle of Midtown Manhattan. That's like an entire city where and they have everybody mandatory in the office, 10,000 people in this one building working there. You look at Apple's and Google's campuses. They are paying billions and billions of dollars into their campuses, not just in Silicon Valley, but in New York and in other places, and Muscat, Texas. So people are going to be working. The question is, in what kinds of environments and structures are they going to be doing? How does that work with the conversion question? So I think this is a very real and interesting one, and I think it's almost bigger than the story makes out, right? It's not just a temporary thing about a couple of properties failing now. It's a really existential question that we don't really have time to go into for the rest of the podcast about, where is real estate going in the future? And the first answer is that nobody knows. I mean, I'm, the Real Estate Board of New York, which I chair the Venture Capital Committee, is, you sit around the table and look at people and say, oh, we don't know. It could go in any one of 6 different ways. So there is no one answer. And this will play out increasingly, I think, over the next 5 years. We're not talking about a 50-year play here. We're talking about having a pretty good visibility into this within 5 years, maybe 10. But by that point, whatever is going to happen, I think the path will be a lot clearer. Either nobody would be working, we'll all be working in our pajamas in our bed, or a pod drinking big gulps or something, or we will be going someplace else and doing something. It'll be a very, very interesting world, but we don't have a clue as to how that's going to play out yet.
I also see this as kind of that scare story, like you're saying. Here's what I like to think about is the building will still be there. It may not be office space at that point in time in the future, but it will be something else. I go back to thinking about COVID, the movie theaters. Suddenly COVID comes out, all your individual apps start selling movies, and the whole movie industry changed. And so the movies, there was a movie, A Regal, being built right down the street when 2020 happened. And I just sat there saying, wow, I'm glad I didn't invest in this one. But what are the movie theaters now? The movie theaters are not as many, but they've changed what they're doing. You go there, you eat a nice meal, those type of things. Whether or not that business survives, the building will still be there. The owners of the building will change it into something else that will bring in money. Maybe later down the road, do we all leave our houses? I think so. I think you'll still have buildings out there that we're always going to. Offices will still exist. Again, I think it's too early to determine what happens in the future. It will adjust, it will change, but they're not knocking buildings down in Texas, surely, because we built this hugely beautiful building, nobody goes to it, and now we've run out of money and we're knocking it down and going back to land. No, it just changes, like the malls. It changes into something else.
Yeah, I very much agree with that. I mean, as I said, I think as long as you have 8 billion physical bodies in the world, they're going somewhere. And unless you think they're all going to stay in their box at home, living totally virtually, in that case, you don't need. Right now, everybody has a home and a workplace, right? Those are 2 different things. So you got 2x the number of space per person, right? And if you say, oh, everything goes virtual and technologically facilitated, and so now I stay in one little place, my little coffin cubicle thing, and I live in an expansive virtual world. Well, that would mean half the real estate, even if the population is growing. But like Matt, I don't think that's the way it plays out. Most people are social, and I think there is a thing about rubbing shoulders with people. One of the reasons people go to malls is not just for the shopping, when you can do it on Amazon, is to be with people, around people. And I think there is going to be a need for people to get out. I know people who have, whether they're totally separate offices, can work at home. They are now being required to come back to the office, and they want to go back to the office for things like mentorship and the casual conversations that you get, that even if you have the most incredible simulated reality, you can't do it online. So I tend to agree with I'm not sure movie theaters are a great example because they are going down literally.
They're changing.
And shopping malls, what the hell? The challenge is if you purpose build something really big, that really can't be used for something else. So we had a very interesting case where we had invested in a data center, that came out of the dot-com crash. It had been built by Global Crossing just at the top of the dot-com crash. It was the most amazing data center you've ever seen. It was just like, redundant everything. And the only problem was after the dot-com crash, we were overbuilt in terms of infrastructure. And what the hell do you do with a data center where nobody wants to put anything in it? So for a while, there was serious consideration of saying, well, maybe this would be like a giant warehouse, like back-end storage, like Iron Mountain. And here you had this thing, they spent hundreds of millions of dollars building this incredible thing, and you're going to use it for storage. Well, so eventually the world comes back in. You need data centers again. So we ended up selling it. Now, had we only held on to it, now if you need a data center for AI, it would have been 2x where you're going, right? So, but I'm not sure that shopping malls are going to come back as shopping malls, and when you have, or private clubs for that matter. But if you have this giant thing designed as a shopping mall, it's a little hard to retrofit that, right? And the interesting question is, theaters may be slightly easier. Okay, maybe you retrofit it as an experiential kind of a place, which needs things. There's a very interesting place here in New York where it's a virtual reality entertainment space. You literally come in, it's a whole empty giant retail floor the size of a supermarket, where you put on a headset and you effectively are walking around in this experiencing a 3D environment, which is absolutely mind-blowing. If you have a chance to try one of these things, you got to try it. But ultimately, where I come down to is I agree with Matt that as long as you have 8 billion people, you're going to have somewhere between 1.5 and 2 or 2.5 physical places or structures, and that's real estate, and that's what we come to. So it'll be a question of then, when do you rebuild, when you demolish and rebuild something new, how do you convert, who owns it, where is it located? And those are really interesting real estate issues, which is why we're all here talking.
Speaking of movies, and one of the reasons it's fresh is because my wife and I went to a movie last week, which is, David, has so much of what you just said built into it. The movie is, I think, good luck, have fun, don't die. And the basis of the premises is AI has taken over. And in reality, people are so hooked on being in virtual reality that's the future, is that they sit there all day. And so now, instead of sitting there all day and having to stop and go eat, we're going to put you in a pod and we'll manage you medically. And so you can be in this virtual world. You'll never leave. And we'll have people change out your pen and everything else. And so,
like the Matrix.
Yeah. The problem with the Matrix is the other way around. It was using humans as the fuel for this computer-done world. I hope we don't get to that, but there is and again, really nobody knows. My friend Ray Kurzweil, who wrote a book called The Singularity is Near, believes and has projected that by 2045, that's 19 years from now, computers and humans will merge. And he means that really quite literally, that we will have one sort of techno-human centric whatever thing, so maybe we are all living in the cloud or something. And that is so beyond the event horizon that nobody can figure out what that will look like, right? All we can say, I'm not even sure we can project at this point, honestly, 10 years out. We're looking now at the next year, 2, 5 max is the way I would want to project anything given what's going on. But I agree with everybody that we will still need spaces, and for at least the next 5 or 10 years, the real estate industry is safe, I think, because it's a question of what to do with it and who has it and how do we all maximize value for us and for our investors.
As they say, adapt or die.
What else are you going to do, right?
Yeah.
Yeah.
And just to add to the statistics, David was saying about, obviously there's more human bodies. So we have a net gain of 73 million humans on the planet Earth every year. So that's a net gain addition. Every 14 years, that's an additional 1 billion people. So just to look at it statistically, that real estate it's got to be used somehow. It can't be like, where are we going to put all these bodies? So like Matt and David said, it's got to change. And I think the article is a little bit oversimplified. There's other factors in play here.
Oh. Well, hey, let's jump into our final fun news item. From Interesting Engineering, China's water battery breakthrough can last 120,000 plus cycles, outlasting lithium-ion batteries by decades.
Well, so the answer is that fact by itself is important, right? Battery technology has lagged quite a bit behind everything else that's going on, right? The AI, and if you think about the AI on the one hand, which we've discussed has passed this exponential takeoff kind of thing. And you look at robotics. I don't know if any of you saw the Chinese New Year spectacle a couple of weeks ago, where the Chinese government did a whole big thing showing robots breakdancing and doing parkour and stuff you would never imagine doing. You now have robots that can walk into your kitchen and unload your dishwasher and put away the dishes kind of thing. So you have incredible stuff there, microbiology and nanotechnology, genetic, all of that stuff is happening. Battery technology has been the one area which has lagged in some of this stuff, even if you have photovoltaic and other kinds of solar power is increasing. But if this is actually translated to the real world, it is a big game changer, because it means you can now you're not replacing batteries. It means you have giant data centers that can have a giant store of things, and the way you build your infrastructure changes over time. So I think on some meta level, this is a really important big thing, but it's very much in the labs now. This is not a here and now going to change anything relative to real estate in the next 5 years, I think, from here. But it's an interesting thing to keep note of.
Go ahead.
I was going to say the advancement, the batteries, what I see and what I hope for is that as they come out better, you'll be able to ultimately store more energy for longer time. And in theory, everyday use goes down in valuation because there's more stored up. Does that really happen? I don't know. It seems to be, hey, they'd be saving money. So we don't normally go in that trend in the US. We want everybody to pay more, but there could be advantages. And then just the cycle being longer, better, rechargeable. It's fantastic because it helps make this transition into more renewable, more realistic. If I'm only going to have something that after 10,000 recharges, I pretty much have to replace the whole system, I'm not ready to make that move yet. And so I think we're getting step by step closer to being able to go in that route. And this is the start of it. But for me, I'd like to see more realistic use of energy preservation and use for, use these batteries at peak hours so that the residents in these towns aren't paying these ridiculous electricity and power fees because you got these AI data centers sitting over there sucking up all the power at the same time. That's how, when I read this article, that was my first thought, like maybe this can lower it down, but you're still going to have to charge these batteries up. You're still going to have to keep them charged. So we're probably not there yet, but as I said, one step closer.
Yeah, just to add another comment is, this is definitely, like David said, this is more of like the horizon. This is very macro level. And this specific article or technology may not change how we use EVs or portable devices, but it's the start of more innovation that's needed for this industry as we're getting more into the whole virtual EV world. Right now, flow batteries are 1/10 of the capacity of lithium ion. So we do see flow batteries being used in battery stations, but they're like 10 to 20 watt hours per kilogram. Lithium ion is 200 watt hours per kilogram. So this is just the tip of the iceberg in terms of innovation. I think this specific technology for flow technology batteries isn't going to be like the major game changer, but it's going to create, obviously, maybe it's the start of innovation to see what technology will actually prevail, whether it's 3 years, 5 years, or 7 years, that will change the landscape in terms of storage, data centers, EVs, mobile devices. But I think this is just the tip of the iceberg, but not necessarily this technology, but just the innovation that's needed or that's lagging, like David had mentioned as well, that has to be caught up to what is needed with all these devices and networks and centers that we're building or trying to build around the world.
For me, I've been just waiting for these battery capacities to increase because I dirt bike, trail ride, and they've got all these crazy cool bikes out, but their capacity when you're really getting after it is maybe 25, 30 miles. And most of our rides are there or beyond. And you don't want to get stuck out on the side of the trail with a dead battery. You can't just easily go get a gas can and fill it up. So we're like, come on, let's go. Let's get that capacity up. We don't care about 120,000 cycles. We care about the capacity. But anyway, just they're working on it. So it's great to see they're making some advances and trying to figure it out. Well, hey guys, that covers the news portion of our show. I'd like to thank our sponsors, United States Real Estate Investor Advertising, Real Expert Talks, and Universe Media Publishing. Of course, thanks to our guests, Matt Meredith, David Rose, Reza Montalbaport.
Don't worry about that.
Yeah, marbles in my mouth. Guys, why don't you let people know how they can connect with you? Let's start with David.
Sure. David S. Rose at David at usremholdings.com, usremholdings.com. You can actually check out the marketplace itself at usremsecurities.com. Remember, this is for accredited investors and qualified purchasers, so it's sort of the high end of the universe. In general, you can check out my website for more of my pontifications on whatever subject you feel like hearing a pontification about at davidsrose.com, DAVIDSROSE.com, which has a lot of other ways to reach me as well.
Fantastic. Matt?
Definitely. Matt Meredith, Meridian Legal Advisors. You can find us at meridianlg.com. On the website, email addresses, contact phone numbers, links to YouTube, Facebook, Instagram. I'm all over the place trying to make that social media appearance. What we do mostly is we are a one-stop shop for asset protection, estate planning, tax strategy, and financial planning. All comes together to make sure that you have alignment and advice isn't given in silos. We work heavy with real estate investors, building out the right structures to protect you and your assets from creditors. If you have any questions, we're always there for you. Give us a call.
Great. Reza?
Yeah, so Reza, you can search Reza, R-E-Z-A, Ingwe, that's our company name, I-N-G-W-E, in another language, that means leopard. But if you search for that, you'll find us, whether it's YouTube, LinkedIn, or even our website. Our website is ingwe.ca. You can reach out to us, and basically what we do is we take the investor out of that local mindset and allow international investment for international diversification in your real estate portfolio or arbitrage. And that's what our expertise is.
Fantastic. Well, thanks, guys. You're awesome. Again, I'm your host, James Brown. Feel free to connect with me by going to Linktree/partner with James Brown. And if you want help on your investing journey, book time with me to see how we can work together by going to jamesbrownrealestate.com/coaching. Also, a huge thanks to our founder and producer, Antonio Holman with United States Real Estate Investor. Follow and subscribe to This Month in Real Estate Investing at thismonthinrealestateinvesting.com or your favorite podcast app. If you run across any interesting news, events, or have suggestions for expert guests like today, feel free to email Antonio at UnitedStatesRealEstateInvestor.com. And remember, when one door closes, another door opens to financial freedom. See you next month.